Hey, welcome to The Market Investor. I'm Daniel Snyder. Thanks for checking out this episode. This one is a special one, all about 401ks, and I honestly don't know anything about it, so I hit up my old college roommate, Boomer, who worked at Fidelity, has a finance degree, has a Series 7. We'll dive into that in the interview, but he dropped some really good points about how to manage your portfolio, what happens if you leave company A and they have your 401k and you move to company B, recommendations on how much you should be putting into your 401k when you're first just getting started. A lot of good stuff. So without further ado, I hope you'll hit subscribe to the channel, and here it is. Enjoy. Hey, Boomer, thanks for jumping on today.
How's it going, Snide? How you been, man?
Dude, it's good. Well, that's the first time they get to hear that my name is Snide.
I gotta call you something else.
That's a secret. So I wanted
to
jump.
Daniel?
Yeah, I'm Daniel. I'm Daniel. So I wanted to jump right in. I know we agreed to kind of have you jump on here. I thank you so much for giving me a few minutes of your time.
Thank you for the $500.
That comes in the check. You'll have to talk to my agent.
Okay, good.
Yeah. So anyways, I wanted to tell everybody the topic that we're talking about today is obviously the 401k. But before we dive into the information you have on that, just your background, right? So we go way back, me and you, but for everybody else, you graduated from college, you started working at Fidelity, and you got your Series 7. Just wanted to see if you could elaborate a little bit on what the Series 7 is and why it matters and just how it helps your credibility.
Yeah, no problem. So the Series 7 test is for anybody that is going to buy, sell mutual funds, stocks, bonds for clientele. So you have to take this Series 7 exam and pass it in order to pretty much be hired by any brokerage. So that way when clients call in, you can pretty much handle any of their requests that they go for. So working at Fidelity, they practiced for a long time, had about 6 weeks of training, thankfully passed the exam, and then had to take a follow-up exam for the 63, which may be credible in Florida. So you pretty much have to do that with every state. So once I passed those, did Fidelity for a while and just continued to trade, and honestly, it was the best thing that I could have done to learn about personal finance.
Right. Because obviously, I mean, as you and I both know, growing up in our school system, we don't ever learn about personal finance.
No, and I had a business degree from the great University of Central Florida.
Go Knights.
And I don't think there was even a personal finance class that you could take other than an elective. Lord knows I wasn't ready to do that when I was 18. Right. So. Yeah.
Well, cool, man. Well, so I appreciate you, again, taking the time. I want to jump into 401ks. This is something that you definitely are more of an expert in than I am, seeing as how I've either been a independent contractor or small business owner. And we have different things, right? We have the SEP IRA and different methods of creating retirement accounts. So I'm glad that you can jump on, kind of help people understand why they're important, what they are, and just how to what to do when you leave a company, right? So let's go ahead and just start in what is a 401k and why should, if I was an employee, why should I have one?
Yeah. So 401k is basically your employer's retirement plan for you. They set it up so that if you decide to opt into it, you can take a percentage of your paycheck and contribute it to this retirement account. So just however much you decide to do, you put it in there and then you set it, let it grow, and then you only take it out when you absolutely need it. I think after the age 59 and a half is when you can take it out without getting penalized for it. But it's the best way to start your retirement through your company to get a lot of interest and dividends and watch that money grow.
Yeah, and I mean, that's really what it's about, right? That's why we're talking about investing and learning how to trade and everything else to make our money, make us more money, right?
Yeah, for sure.
So how much should I go and I start working for company A? And company A is hey, here's your salary, here's the benefits we offer. One of it is the 401k. A lot of companies offer, well, let's talk about this. They offer employee matching, but also just as the employee, how much should I be putting in? And what is employer matching? And just run me through all of that.
Sure. So I guess I'll take it from a personal level. When I first started out, Didn't have too many expenses or anything like that. Still lived at home. Not all of us get to have that luxury of zero rent.
It's the millennial lifestyle.
I know. You just ride that out as long as you can.
Right.
But I would say if you can, maybe contribute $100 a week just to start out. If you're first starting out and that's, all that you can put towards it, that's a great start. I think, by the end of that.
So you're talking about $5,200 a year. If you're
$5,200. And that's before, you see any kind of growth or interest in dividends going into it. So if you can calculate it where you just do $100 a month, I like to use the number 5%. If you're able to set that much aside. But really, if you have not too many expenses and you just kind of have money that you want to be saving, if you're able to save it and you can, withstand keeping it in an account for about 40 years, I would say try to do as much as possible. But I think $100 starting out is a good starting point.
And so with that $100, I take it out of my paycheck. Is that does that come from my gross amount of money that I earn, or is that before taxes, after taxes? How does that happen?
So it's before. So it's going to be deferred tax growth. So it really comes out of your gross paycheck. So however much you're putting into it, once you take it out, you'll have to pay taxes on it. But not having to pay taxes for it up front and watch that grow. A lot of people, try to opt into that to get that tax deferred growth.
Right. And so what about the employer matching, right? When my employer says, hey, I'm going to offer you employer matching of 4%. Like I really don't know what it is, but I know that employers out there do offer matching of a certain amount. What is the process of that?
So it's pretty similar just to how you naturally contribute to an account. So I know a lot of them will do certain tiers. You may do a 3% for the first year, 4%. As long as you stay for the company, they might even go up to 7%. So really, say you're contributing 5% of your paycheck and that happens to be $150. If a company says that they're going to match that 5%, then they're going to go ahead and add an extra $150 to your monthly or your weekly contributions. So that way you're just putting away $300 of your paycheck into this 401k while you can watch it grow. So I think if you ever have an employee matching plan, at the very least, try to get to the maximum that they'll contribute with you. And then if you have the extra funds to, put more into that 401k, I say, go for it, because you can always watch it keep growing.
Is there any limit that you can put in for a year's time?
I need to look at the number again.
But there is.
I think there's a limit to the contribution, but most people try not to put they don't want to do 50% of their paycheck into it.
Right.
If you can, power to you, but
starting out is kind of hard to do.
I've never been able to do any of that.
Right. Okay, cool. So when you get a 401k, do you have control of it? Like, what is like I put money in, is there somebody managing my portfolio? What are they managing? What is inside of a 401k?
Sure. So it depends on the company and kind of what your preferences are. So a lot of companies will do something called a target rate fund, or a target date fund rather, where they pretty much pick when you're going to be retiring. So say it's 40 years from now and you're first starting out. They would put you into this target date fund, probably called Mutual Fund 2060, where since you are younger, they're going to put you into heavy stock invested mutual funds, which are usually just index funds that they kind of create for you in your portfolio. But they'll also add a little bit of a bond fund as well. So that way you kind of get that early interest and dividend. And then as you continue to go throughout your career, the target fund will pretty much manage itself to start selling more stock index funds and then buy you into more bond index funds. So that way, as you continue and get closer to your retirement, they try to give you more interest and dividends. So that way there's less risk in your portfolio. But some people will also have the freedom to do it themselves if they choose that they don't want to have too many stocks for starting out, or they feel like their target rate fund is too bond heavy or stock heavy. Either way, you can pretty much go in and create your own portfolio, just depending on whatever your company allows. But I would encourage people to do it themselves if they
man, that's why I am a firm believer. You got to take control of yourself. Like when you are younger, go into those stocks, find the growth, find the, dividends can be paid long into the future, but find something like, I love Tesla, right? Tesla's such a growth company. Right. And just play growth and take on the risk when you're younger, because there's decades and years for you to get the growth aspect and really bounce back. And then when you're 50, 60, whatever, when you want to go into bonds, like I personally hate bonds, but I know eventually someday when I, retire and want to have a steady amount of money that I know is not going to disappear from a market crash, I'll move into the bonds and I'll move into dividends or REITs or whatever, is the best. Yeah. Mode of transportation at that moment.
Absolutely. No, I complete agreement. Try to do as many stocks or stock index funds as you can.
You gotta have the stocks when you're young.
Total market fund, S&P index fund, anything like that you can get into.
Yes, that's what I say all the time. Start with an index fund, track the S&P 500, something with a super low expense ratio. I think Vanguard, the minimum is usually around $3,000 for an index fund to start. So you got to have that. But after that, like put it in, don't touch it. Let it go forever.
Exactly.
Another thing I want to talk about though is, say I'm an employee of company A, right? I've been there for 5 years. Obviously I'm just starting out. I take the 401k, I take the matching, all my, I've seen my 401k grow to $50,000, $60,000 wherever I'm at by the time that I get a new job offer from company B, right? Because sometimes you get maxed out on the ladder in the corporation. That's just how it happens.
Sure.
So if I'm going, okay, I am leaving company A, going to company B, taking the pay raise, taking the promotion bump. What do I do with the 401k in company A? Do I just lose it? What happens?
No. So, you get to keep that as, that is your money that you've earned, that you've put into it. Some companies that may have done a matching principle may take some of that out if you didn't get to a certain vesting period, I guess. That's more getting into restricted stock options. But for 401k, if you've been with them for long enough, then you should be able to take that entire thing. I would advise, and this is pretty common, you can either keep it in that 401k for a while, and then your broker, you can, just continue to use the same one that you had. But others, they may encourage you to take it out and put it into a rollover IRA, which is pretty much just, a retirement fund where you can take your 401k, put it into a very similar type account, and be able to pretty much do the exact same thing and contribute, any way that you can. So if you have a rollover IRA, you can continue to put money into it. You can choose whether you want to do, tax deferred, however you want to do it.
Will you lose any money though if you transfer from a 401k to an IRA?
No.
So it's because you're transferring from one investment vehicle directly into another. It's like transferring from one broker to another broker, as long as you do a broker to broker transfer fund.
Exactly the same thing. Yeah. If you choose that you want to choose one other broker, you pretty much could either keep it in the same fund and, work with your broker to say, okay, I want them to come into this account, staying in the mutual funds that they were with. Can you work with me? And they'll usually give you a form to fill out, tell you, which funds do you want to put them into if you want to do a transfer. Or if you want to sell them out, put it into, a money market fund and then start reinvesting it into something else. It's your cash. It's however you want to use it. You've earned it.
But if you do take the 401k, say I want to put it into Roth IRA. If I want to change the type of investment vehicle, there's typically some sort of tax thing that has to happen, right?
I think, you have to treat it pretty much as income. That it comes out that if you want to take it out, you pay the taxes on it and then bring it into that Roth rollover IRA. So that way, you can get that tax-free growth after that point. I would say, for the sake of making it more simple, keep it in just a traditional rollover IRA. But if you also, that's another thing that we could also talk about. But if you have the option, you can also do a Roth 401k. And then when you have that, you can also roll that over. And then I would say keep that in, a Roth IRA. So my advice would be to keep it in the same family. But if you choose to do that, work with your brokerage.
Well, no, that's great advice, because typically somebody might be like, well, if they don't know about the tax implications of taking the money out of their 401k, getting hit with that short or long-term capital gains tax, which are different amounts depending on the amount of time of what money was in what. I mean, that's a whole complication. And if people just want to avoid that altogether and not have to deal with that, not have to deal with losing all the amount of money to taxes, keep it in that rollover IRA.
Exactly.
That's great advice. That's great advice. I do have one more question for you. For the people right now that have 401ks and say before this whole bear market crash happened, this whole pandemic came down. I mean, do you recommend people look at their 401ks right now to see the amount of losses, right? It's paper loss. It's not realized loss, but
sure.
Should people torture themselves to look at them right now? Or do you want, like, is it better just for people to like push it to the back of the mind, not even look at it, like let the money just go?
I mean, that's an opinion. If you choose to have ignorance as bliss, then, maybe don't look at your 401k right now. You're like, man, hard earned money. I know it's growing. I've got interest in dividends. Everything is going to be definitely accumulating. There's no way that the market can affect it right now. That's a lie. I checked my 401k this morning and definitely have lost a little bit of money since this first started out. But I think it's also a learning experience that even if you are losing money in the short term, you've already seen that growth accumulate over a while. So you can look at the transaction history, see what you've actually earned just from, the money that's been going in there and growing. And then when all this is over, the 401k is the long-term plan. So this isn't something that you're going to be taking out and trying to mess with and do, stock trades, day trades all the time.
Right.
You're going to keep it in these mutual funds. You're going to do index funds and see that it's going to continue to grow, over the lifetime of its account. So I think it's okay to look at it because it gives you the opportunity to also modify your 401k that when the market is at, this low point, this is a good time to contribute even more into it. Because I don't know about you, but a lot of people have been staying at home, limiting costs. They can't really go anywhere. You can't travel. You've probably gotten refunds on random stuff that, you had planned on.
Right.
But you really just need to reevaluate. If you're able to put more into your 401k right now, I think this is actually a really good time to do it because you can start seeing that market growth and, add more money into it. So that way you are just invested in more mutual funds and then get that bigger growth when the market starts going back.
Yeah, man. It's an incredible opportunity for people to just put their money to work.
If you got it, I would say put it in the market. If you got it. If you got your job and you got some money to put into your 401k or any kind of brokerage account, I would say do it right now.
Yeah, man. That's what I've been telling everybody right now. I've had so many people ask me, like, how do I get started? I know stocks are cheaper than what they look. It was January, right? Hitting all-time high after all-time high, and then all this happened. Here's a question for you. Do you think we're at the bottom?
Man, I don't know. It's tough because we were I think Dow Jones was in the 18,000s 2 weeks ago, something like that. But I also think that even if we're at this super low point, this is the lowest it's been in, 4 years, pretty much.
No, more than that. I mean, it hit the low in 2008, 2009. I mean, that's...
Since the recession. So even if it's not at the lowest point, which nobody can really ever predict, you'll see that the market, the index funds that you're invested in, any stock is way lower than it should be. Maybe the market was a little overinflated before, but if you do your analysis, you can see that we're definitely in a dip that if you're able to hold it for the long term, I think that will bounce back pretty quickly.
I completely agree.
So even if it's not at the very bottom, I think most of the investments that you're going to go into will profit at some point.
Oh, 100%. Find the dividend stocks too, right? The ones that aren't gonna. I mean, look, every company is slashing guidance, and I'll do another video about that soon about how we can't actually price what the stock is right now.
Right.
And a lot of companies are, of course, slashing dividends like AT&T did, right? So you got to find those nice needles in the haystack.
Absolutely, yes. See what you can do. I try to diversify so that if you have faith in that company, like those Teslas. Like if you know that they're going to grow or double in size in the next couple of years, if you're willing to do that and you're willing to take that risk, go ahead and invest it. If you need something now where you just want to buy Ford stock where it's never going to move and you want to get a ton of dividends, I say go for that
if they keep their dividends at this point.
If they keep it. That's where you go for those too big to fail companies that they're going to pay out. Maybe it's not going to be the best payment right now, but I don't know. stick with what you know. Stick with your loyal companies. Stick with the big ones. Don't try to get cute with anything. Don't do penny stocks. That's a completely different conversation.
That's a trading, man. Well, that's another, yeah. We're talking about investing right now. 401k is an investment strategy. It's not a trading strategy. No. It's a good technical vehicle to help build a solid foundation for just starting out or just in general, really. So
hey, I mean, we don't have Social Security when we're going to be older, so
that's a whole other.
They didn't have IRAs or 401ks.
Man, that's a whole other topic. We got the baby boomers. Yeah, man. All right, well, cool. I won't keep you any longer, man. I really appreciate your time and walking us through the 401k. And I just want to encourage anybody that if you have any questions for Boomer or myself about 401ks, specifically Boomer, because he knows more about it than I do, leave them in the comment section below. I hope you'll hit subscribe, and we'll see you in the next video.
Awesome. Thanks, guys.